Jesus. Can everyone hear me? Let's see. There we go. That should be better. Perfect. What's up, Adam? All right. This should be better. Can everyone hear me? I say a little better, but what if I turn this off? Here we go. I say a little better, but here we go.
All right, nonetheless, we'll work with what we got here. So hopefully everyone can hear me. All right, let's dive right in. So first things first, we have the NASDAQ and we have the E-mini futures. Let's look at a weekly chart. I think a good topic of conversation today is what what inspired most of you, the ones that are here, what inspired you to become a trader? I'm genuinely curious. Would anyone like to share that? What got you started? So crazy. Before we delve into the algorithm, I'd love to hear some thoughts. All right. You see, a lot of the work that you will uncover will be done on a weekend. And a lot of people do not realize that. Believe it or not. And why do I say that? Well, first of all, you get to see how. Let me turn this off because it's double capturing. You will be able to see essentially how price does repeating things. Now, to some, that may, I'd argue, like ICT last week said, you have to be able to study these things together. And you have to look at it in real, like market replay is not going to be enough. This is not enough. You have to actually watch the candlesticks print live because that's going to give you the experience. I'd say the number one thing that a lot of people misunderstand is the experience portion. If you do not get the experience, then in turn you will not ever understand how the market operates. Now, I have been inactive for some time. I don't really care if there's 5 people, 1 person, 50 people that look at what I post because I know what kind of knowledge I carry. And I know that as long as I help out 1 person, I will be sufficient. Yes, I have a private group. Yes, it costs money to be in, but you also have to realize that I provide a ton of free value within my Telegram that goes beyond what most would even cover. If you study everything that I've said publicly, pinned messages, whatever it may be, and you start piecing things together as I did, well, I'd argue you could probably put yourself in a pretty good spot because I stopped YouTube. I stopped telegramming for a bit. I've telegrammed, but the reason I stopped is because I ran out of things to really go into because the market does repeating things over and over again. So for me, it does get hard. I'm not here to uncover PD arrays. I'm not here to make up something else and call it my own or anything like that. I only use what has been taught, which is liquidity and efficiencies. That's it. That's all the market does. Right there. Moves back and forth to these by nature that. And that's all it does. And all it's waiting for is time and price for what these are to align, and then that's when you get your algorithmic signatures. Now, for me, I personally, this is where it gets hard. Not hard. I don't want to say it gets hard, but you have to understand. For me, let's see. When I'm uncovering certain things, I'm looking. I'll add this in discovery mode. When you're at all-time highs, this is what you get, discovery mode. So there's nothing for it to refer to other than a standard deviation that is simply measured, right? And thank you, Adam, for sharing that. You want to achieve financial freedom. Well, I'll be the first one to tell you that I've lost a lot of money trading. When I first started trading, it was back in 2020. I was using Cash App to trade AMC. Maybe some of you remember that, maybe some of you don't. Then I moved into small caps. Trade a little bit of large caps, but mostly small cap trading is what I did. I also traded over-the-counter stocks, if you're familiar with that. Basically penny stocks, and you're basically studying underwriters, these people that have these companies and then they get bought out, and you had particular underwriters. If you were to study and uncover that stuff, you'd realize some of the underwriters there always had successful businesses or always had price runs on certain, over the counter stocks. And I mean, you could get anywhere from 10, 20, 30,000% on some of these things. And it required a lot of studying and, uncovering whatnot. That's kind of how I got started. I got paired up with, it was no different than what I am, today. I found somebody that was like a needle in a haystack. He didn't know a lot of people, but he was very knowledgeable. He's very rich, and he, didn't really care to be that public. His name was Prince. I will never forget that guy. He traded IBKR, the broker. But very knowledgeable guy. He uncovered that. He found a way to, that was his edge. His edge was studying underwriters and trading over-the-counter stocks, or, small cap stocks that really had a good, even that came out with FDA approval stuff. So mid cap, small cap, anything like that, even large cap sometimes. But the key, aside from all of this conversation, what do you need, whether you're stock trading, whether you're small cap trading, options trading, because that's what I got into next, you need edge. If you don't have an edge, no edge means you get no reward. Right? So you had to discover an edge, and that edge requires hard work. Now, for me, I didn't want to do this studying on underwriters, and I didn't know even where. I mean, I kind of knew where to start, but yes, it gets a little weedy. So I didn't want to do it. I was lazy. So then I moved into options trading. Met another guy. He had a free Discord. This was, probably a year and a half after starting, and I started trading options. Trading small cap options. Of course, it was people that were posting their options, and I'm sure that a lot of people can relate to what I'm saying. But anyways, point is, and you might not find this interesting, but what I'm trying to do is relate to you, because I know a lot of people. I'm going to gear up towards how I got into this. So, people were posting, all these little channels were posting all these same trades. Hey, getting this call for 3 cents, and it's, they pushed out with the quote unquote volume, and that's how they got their money. And I was, the last one to take my money off the table, and I lost a lot of money. I was stupid. Now, then I discovered trading SPX options, and, I made better money with that. I felt like, hey, I actually have a chance at this. And then I was, from option trading, you kind of get to the point to where, like, okay, I want to do some swing trading, or I want to do, I want to catch those runners at the end of the day that go up 10,000%. Well, I was essentially looking for a fast way to get rich, and you can't do that. Not in trading, not in options, not in anything that requires you to come out on top on the other end. Is if you get there the easy way, you're going to lose it just as easy. So you need to get there the hard way, and don't let that scare you, because it's very true. But nonetheless, I would certainly encourage you all to get on board with studying, putting in the work, and making sacrifices, because that's what it requires. Now, at the end of my options career, which wasn't, I spent a year and a half on that. That's kind of where I discovered ICT. So I was trading options, discovering ICT, trying to utilize some fair value gaps, and, this guy claims he knows the algorithm. I didn't even know what the algorithm was. And I saw people started getting in trades before they happened. How do they do that? That's what landed me to wanting to discover, how in the hell is this possible? And I thought I had it figured out. There were many times in, this journey where I thought I had it figured out, and I didn't. And so I didn't have an edge, not also go to this fair value gap. So in return, would you agree that that's some form of SMT? Well, Yes, I would. Regardless of how you see that, right? Well, you start to uncover. I got into, about a year and a half. I took a lot of notes. I was, studying the candlesticks. And then I came across ICTFR's, page. And he said, study the algorithm, not the markets. And that dawned on me. That hit me hard. And it took me a year and a half, 2 years. I still lost money. I probably lost the least amount of money from trading ICT. And then right before I even got into the algorithm side, that's where I really actually started making money from, trading and recouping losses and really just trying to get back to break even from everything. And, some days you get there, some days you don't. There were days where I was up, 10 days in a row, and then I'd lose it in one day. So yeah, that was more of a risk management thing. So not only do you need edge, but you need risk management. Why? Why do you need risk management? Because there's a principal conversation, but there's a compounding conversation. Because just take $100,000. Let's say you gain 10% on that. Well, you get what? Well, what would you get from that? Well, it doesn't matter. It doesn't matter if you use this with 100,000. Doesn't matter if you use it with $100,000 or $10,000 or $1,000. Point is if you lose money, let's say you lose 50% of your money. Well, if you were to gain 10% off of that, then what do you have? Well, you basically have half. So if you cannot manage your risk, you have to work 10 times harder, or 1.5 times harder, to get back to where you even were. So, risk management is a key thing that in turn will favor you, because if, let's just say, just pretend this is a 1 minute chart. Well, if I bought at this SMT here, and my stop loss becomes, what ICT taught at the low of this the candle that creates this fair value gap, and I have a small stop loss. Well, let's just say it dips right there, and I get taken out. Great. So I essentially, if I use a measuring tool, where would that be at? Let's just say, my entry was at the midpoint here. Okay, we lost 3%. All right, cool. Okay, I lost 3%. Well, what happens if you lose double that? And you lose 6%. Well, guess how much you have to make up for that? You have to make 12%. So not only do you have to do this, you have to make up, if you were to rebuy, your price here has to go up here to even make back what you had. And it's always because of that principal conversation. So, point is, you need risk management. You need to be able to control yourself. You need to understand, because if you go in order, this will be the order it happens in for you to become more successful. Okay? And I'm just being flat honest with you. Most of you, 90% of you, probably will not make it. 80, I'd say 90% will not make it trading. It will never be your source of income primarily. Hard root to swallow. Well, I'd say hard pill, but whatever. And that's why most people give up. This is not a hobby. If you want to get rich quick, go to a casino instead and try your luck there. So let's put it on this side. Because a lot of people, and I hate to be the bearer of bad news, but this is reality, and I'm a realist. Now, I will say that trading itself is not my primary source of income because you have to go through phases to get there. But you have to be on you have to be on the proper trajectory. Proper trajectory equals supplement current income / make ends meet for an extended period of time. Be able to repeat what you do successfully. Okay? That's reality right there. You have to start with making ends meet. And I mean, ICT has said this several times. I don't care. The algorithm means absolutely nothing unless you understand this. So what do you have to do here? You have to control yourself. Manage your risk. This is why you have to start with demo. Okay? Now, ICT tries to, ICT has, faith in a majority of people, but at the same time, if you don't do what he's telling you to do, you will not make it. The algorithm doesn't matter. The algorithm wouldn't matter to me if I can't control myself. If I move my stop loss lower because I'm like, oh no, like it has a chance. No, that's not true. Because the true algorithm says if it goes beyond this barrier and it does what it's not supposed to do, then it's going to go against you, out of your favor. It's not in your favor anymore. And that's okay. It happens. But you have to be able to manage the risk. Because if you can manage your risk, you have to be a money manager. This is a business, right? This is a business. You are managing money and yourself. This is a solo business. Okay? Awesome. So let's understand that first and foremost, because if you can't get this down, well, then I'd argue that you're probably not going to make it. Dylan, what do you mean by why do I think what is? Why do you think that is psychological? Why most won't make it? Because they can't get this down. Because I did the same thing when I started. Can't control myself. The algorithm doesn't matter. Because here's the reality. Reality is, if you can manage risk, you can simply flip a coin, and if it's a heads, you can buy. If it's tails, you can sell. Do that every day. As long as you manage risk, you have a better chance of success. So that's what I would argue. So you have to be able to manage risk. If you can do that, you can simply flip a coin. It has nothing to do with, yes, it is psychological from a standpoint of you get in your head / strategies. If you have the intent that I have to get everything back right here, right now, you're not going to make it, because that's not like, I don't remember what ICT said as like take 2 losses a day and then be done. But yes, that's what it was. Risk half of what you did the first time. So if you trade 2 mini contracts and you lose, trade 1 mini to get that money back. So you're not doubling down your risk. That's the easiest way that I'd say start managing risk. If you lose, use half of what you used as your original starting. I don't know what I'm trying to say. If you lose, use half of what you used from your original entry to successfully recover what you lost. This way you aren't risking more. So don't go try to push on 2, 3, 4, 5 contracts after using 2 contracts. That's what I am trying to get you to understand. Because if you can't do this, and it sucks, yes. But if you can accept losing days, you're fine. Like, there's nothing, hey, I'll get it back tomorrow, whatever. But this is a reality check, and it really is. And I would say don't waste your time trading. This is why I charge people to get into my group, because it's a very serious thing. If you pay money to get into it, I know you're serious. And to point it, I don't teach for free. I mean, this takes a lot of time because I've spent hours and hours and hours studying this stuff. And even if I lose, I'm not afraid to admit it, but I can always go back and see where I lost and why and what the algorithm did, because it's always the same. Anyways, this is first and foremost the most important thing to, I believe, becoming a successful trader. You have to be able, because here's the thing, you can't put yourself in a situation where your back. I don't want to say you can't do that, but because you can, but don't put yourself in a situation where you have to depend on trading income, because I've tried that before, and not have a nest egg saved up for it. Because ICT says you need 12 months of income at least to try to do this on your own. That way, in the event something happens, because there may be some days you don't make money, some days you do, but you gotta have the nest egg, and then you have to have your trading capital. So do that. But anyways, this is, the reality portion of it. But yeah, we'll kind of jump in to a little bit of review. I was pretty bearish from April, right in here, April, mid-March, all this. It's pretty bearish. I was not expecting this run, 800 points on the 800 points on the ES, but recommend the 2024 mentorship. Sorry, I'm reading some of these. Do I think the 2024 mentorship will save you? No, I don't. As far as the algorithm goes, I don't really. I mean, what ICT has been teaching is the algorithm, obviously, but he's just convoluted new language to add to it, so it's a little different, because he's taught a lot of new things. But I mean, just 2024 is good, 2022 is good. The original, I will say, the core content is very important to study. Core content, extremely important. It goes over a lot of the basic stuff, and I think the basics is always where it ends at, because reality is, for me too, if I wanted to sell you something like a model or anything like that, I could make a handful of them. I could make my own language out of this. Not these candlesticks. I would do it a different way. I would only talk in a more binary form. But point is, and someone mentioned it in the group today, that we have a lot of inefficiencies left behind. That is true. And why is that true? because this is what's happening. See if I can find it. I'm going to show you something right here. See that? It's an endless loop. And it's repeating. And it has no interest in coming lower. It's just repeating constantly, leaving things behind purposely because it's on a mission. So what it's doing is there's a feedback loop basically. And it starts here and says, okay, this occurred. Where are we at now? Actually, let's start here. Okay, this occurred. Where are we at now? Okay, we're gonna go back here. And do we need to go lower? No. Why? Because the same function performed here that says continue. Now until this happens, until you get I wonder if they have it on here, let me see. This would be helpful because it works. Ooh, maybe we could do it with this one. I'm sure I could rotate this right. Oh, here we go. Here we go. Alright. It's a feedback loop. So it can goes here, and once it gets here, it's a fork in the road, and it says, does this happen again? Yes. So we keep going. This is the inefficiency route. Do we go back and touch the inefficiencies? Yes or no? Continue. Algorithm. Equals feedback loop. Okay. Continue. Inefficiency. If you leave an inefficiency behind, okay. So it's cycling through here and it says, do I continue or do I retrace to the inefficiency? And if I retrace into the inefficiency, which then becomes a point of interest, does that, let's see, continue on the path we were on and gets back into this feedback loop. Okay? We are performing a function of, okay, we're going to a point of interest achieved. If so, we come back to this, and I'll show you exactly what this is. Give me a second. And cycle starts over. All this is right here. Give me a second. Let me read the chat. You're welcome. Thanks for joining. All that's happening is this is internal to external. That's all. That's it. That's all this is. So there's a constant loop. It's a feedback loop. So it continues on this within, let's just say that, for example, we get And let me screenshot this 1 second so I have this. Give me a moment. Here we go. Fantastic. Okay. Does anybody have any questions before I proceed? Can you talk more about time cycles? Time cycles don't exist. ICT has said that. There's not a loop of time that's continuous. There's no time-stamped candles. There's no time-stamped candles. There's no. How can I? I'm trying to. There's windows of time that the algorithm refers to, as the ICT has said many a time. But there's no such thing as a time cycle. So the algorithm is not cycling and doing like, oh, at 5:58 every single day is it going to do the same thing? Or you have these 10-minute cycles, these 15-minute cycles. Like, yes, ICT can trade. It's hard to call them cycles. They're not cycles. He can trade every 15 minutes because there's things happening on the basis of time where the algorithm is continuously cycling to and from, back and forth, back and forth. And it amazes me how no one has ever caught on to this, but I always think back to where I was from the get-go, from the start of all of this, where I only stared at candlesticks, FVGs, things of that nature, order blocks, and now I don't see them as any of that stuff. It's more of, as soon as the algo performs, I'm trying to figure out a way to explain this in a manner where you may understand it better. So give me a second to process what I'm trying to say, because I'm trying to explain there are many different ways to get into a trade. There's the low risk entry, but the low risk entry is a very specific entry. And then you have institutional order flow entry drill, which is a specific entry, which gives you a good move forming from that. And then you have the I would say the market maker models would be the best thing to study, because you have to study what's occurring at those events. So the second stage, reaccumulation, all of that stuff. You need to go study what's happening at those points in time and what it's referring to, because that's the quote-unquote cycle or sequence that it's running on. Is it's doing continuously, the same thing. It's this conversation again. So why are we not getting any return back into here? So one may say, well, hey, I'm waiting for this to go back in a discount, or I'm waiting for, what happened here. Well, it doesn't need to go there. Now, I'm not going to teach you why it should not go there, because damage has already been done elsewhere. Now, that's not to say on the on the weekly chart, that's what I'm talking about. What I'm trying to get you to refer to is, 15-minute chart. And I think it's also important to understand that when a lot of people expect price to retrace here, they're not studying what's happening beforehand and saying, well, what happened beforehand and why would I need to come back here? And do I need to? Because If not, it's just going to continue like so. Do you see this? Let me see here. No. So you see what's happening. But then you have this gyrating action here, and you would argue it did come back a little bit, then it runs higher. Then you have this, and it runs higher, right? Now, ICT will say, okay, well, if we have, if you take this Monday and you have this 30% of the range or whatever from Monday, let's just take this to here. That's Friday. 70% of this, 30% retracement. I probably am expecting that to come Monday or so, because if TGIF doesn't occur on Fridays, we always expect that to happen on Mondays. But don't force it. Please and thank you. And if you're here, if you could just like the video, that'd be fantastic. Just let me know that you're actually paying attention. And I know I've talked a lot before actually getting into this stuff, but I think it's important to talk about this stuff later on to get you to understand what's actually happening, because there's a cycle of stuff. This is a 15-minute chart now. What you need to identify is, are you day trading or are you swing trading? I'd argue that probably 80% of the people are not, you're not swing trading, you're day trading. So why do you need to go on anything beyond a 15-minute chart or an hourly chart? Like, you don't need to go down any lower than that. Like, I meant any higher than that. Yeah, you do have some daily stuff. I see nothing wrong with going to a daily chart, identifying some daily, stuff. Let me take this off. Where's my selector tool? Erase. Okay. All right. Well, yes, you can go onto a daily chart, but like if you just look at this, 9 up close candles, 1, 2, 3, 4, 5, 6, 7, 8, 9, 10 actually. 10 up close candles. Well, like this probably could have been a reason to move higher. You have this on a daily chart, obviously. What you're trying to identify is, like I told you, it's kind of all the same, but what are the last candle closes down that created excuse me, that created this move lower, that are then used to go higher once you reach a point of interest that it's trying to take out. Now, realistically, I would have looked for a draw into here, and I believe I did. I looked for a draw on liquidity into here on a daily chart, and I tried to short one day, and I got stuck at break even, and I realized how strong it was, and then I said in obviously the public group, not to fight it. And then from there forward, I've just been longing most of the days. Friday I did one a little short, but obviously the inversion did not even occur. Just used the fair value gap noted as a move high. But going down to a lower time frame, recall everything you just saw. I'm going to be the first one to tell you that I do not put a lot of stuff on my chart. I do not like a lot of stuff on my chart because I'm only watching a few things at a time. I'm not looking at anything else. So, anyways, what's going on here? Okay. So, as you can see, you have all this price action. Remember, whether it's a 1 minute, a 2 minute, 5 minute, whatever time frame you're utilizing, its price is the same. It's always the same. It always will be. But once you add in the context of time, that's when you obviously get something more beneficial. Now, if you see right here, these are obviously going to at some point the market has to make a turnaround, and you have to get out of that feed loop, that feedback loop cycle. Sorry, where you start engineering liquidity. Okay. Now, what would that even entail? Because here's all that happened. You get this engineered liquidity, bam, price does what? Comes lower, comes into what? Fills in some of these inefficiencies here. These were already filled in here. But you have these here, right? These were already filled in. You have a little portion of this left, doesn't need to go back. But then what? We start moving higher again. Well, if you take this move, this is the last down close candle, and you drag it over here to the right, and essentially you see this back and forth action, right? Now, this is for you to study, but this happens more often than you think, and then this occurs, okay? This specific candlestick at a macro time is utilized, and you will often see people like ICT enter in right here, or right here, but I'd argue it's right here, and he's looking at something like that. Now, most of you would do this. Closes above, comes back in here at 1406, you're going to buy. No, that doesn't happen. This is the conversation where people get hung up on. They get so hung up on that, they don't know what to do. And I have studied, that is exactly what pissed me off back in the days, because I saw ICT. How in the heck did he time a trade where he purchased it right here? So I would love to know. I would love to know. Well, I would argue this is exactly what happened. The algorithm simply waited for a signature in price to occur, right? That's one of the many dozen signatures that occur in price, okay? Now you can see that ES did not get above this. Well, here it did, but as stated, there's no quote unquote signature in price for it to be able to be delivered higher. Now, this could be utilized if you're advanced, because you have this macro here, 1515 open. An advanced individual would purchase it here, okay? It's a low risk entry. Your stop is like 5-10 points, okay? But essentially you're looking and obviously trying to identify sorry, I'm looking at this thing. Essentially you're trying to study one of the many signatures. Well, you have to, there's not always going to be SMT. That's not always the case. So you have to understand that that doesn't always happen. But what you could do, obviously you could have purchased it here, because you get a fair value gap that forms after an algorithmic signature is present. And I'd argue that's another strong algorithmic place to purchase, okay? You got the last down move, right? The last down move that shot price higher. And I don't know if most of you studied this the other day, and I just want to see what happened. But sometimes at 11:30, like here, we get like a price move lower. And so what you can do is take one of the, it's very tiny, but it's very important. We'll do this right here. This is in the details. We'll see what happens. Take one of the last fair value gaps before taking out these highs. It's very small and minute, but you want to carry that into the next day, and you can see some stuff come out of it too. I would probably be more poised to using this one more so. I just like that it's bigger. Extend, right. See how much significance it has once it gets back above and stays in there. But you carry that over to the next day. So anyways, there's a lot that goes into, obviously, there's a lot that goes into this algorithmically, but it doesn't really have anything to do with, in reality, fair value gaps. True fair value gaps. But anyways, they are important, so obviously I have them on my chart, but you can see this right here. It only waits for the market to get into a macro and then sells off, right? But you see the importance of this. You have 1130, run higher. That's a false breakout. You know that. Drops down lower. Oh crap. And then you come here, sell. Poke it, sell. Take something in here, whether it's here, off. Create these equal lows, bam. So there's a lot that obviously goes into the algorithm, and there's so many things and whatnot to study, but it's the way you study. The way you study is just as important as what you're studying. Because if you're just studying this, oh wow, I found a down close move that acted as an inversion. Okay, well, why this fair value gap, or why that fair value gap, or why this order block, why that order block? There's a lot, and you have to pair time with it. And this takes a lot of time, guys. It really does. And everything is obviously on the basis of premium and discount. It's very important. But not only that is there's a lot to study. Does anybody have any questions over any of these? Does time play a big factor in selecting? Yes, correct, it does. Correct. So V trades. That is a good question. How do you know what fair value gap will be respected, or when it's reclaimed, or anything of that nature? Well, let's see if we can hunt one down here. What I'm trying to look for. I'm trying to give you a good example of what's a reclaimed fair value gap. I mean, you could say this one right here, but I wouldn't use that to. You would want to find something that's bullish, for example, that was like this here, and then that's reutilized. It's a reclaimed fair value gap because it was used as inversion first, and then you have 1030, time goes higher. But yes, you will see fair value gaps get disrespected, and then they come back above them in a key time and then reutilize them. It's no different than the actually, I will show you a good example. So you have 930 open here. Here's the first fair value gap. First fair value gap is a down close, so always assume that will be used inversely. I know it's quote unquote not used here to go lower, but typically it is. And it's a move lower that then turns higher and at a key time. So you have the macro here. Well, this also aligns with this fair value gap too. So sometimes you'll see this this SPICY form here, and you'll be outside of a key time, and it'll come lower here, and then it reclaims itself at a key macro time. but it's just a false move. That's why I've said in my public group many a time to treat everything like a first fair value gap. Because whether it's, I don't know, it's you're going to use a lot of stuff quote unquote inversely to each other, but they're really just reclaim things that so freaking important. Okay. Would any of you want to buy up here? This is a realistic question. Would you see this up close move and you want to buy here? Yes or no? And you can be honest. Hey, the market's going higher. I think I should buy a fair value gap that's, you know, it's going to move it higher. I would like at least one. I bought right before that. Okay, so did you buy on in this leg up higher? Yeah, the first retrace. Okay, so you bought here, right? I assume you bought here, if that's what you're talking about. No, it was exactly 26,790. Okay. Ah, I see. So in here. Right in here, right? Oh, this one. Okay. So, okay, good. That's a great note. Now, I am not going to, this is a very volatile market, so I'm not going to fault you for buying here. But what I'm trying to tell you is if this high were to be the one that got ran, and then we just accumulate above it and then fell lower, you really lost a lot of the move because you want to buy on retracements like this. This is where you want to buy retracements because what the algorithm's doing is referring back to, you know, a key time opens, and that's all it is. So if you look right here, and it doesn't have to be this specific, but what's happening is you're buying below the 930 open in here. I know it's smaller, but it's already kind of low enough to where it doesn't need to go any lower than that. Point is, you want to start trying to buy things like this is why you get this move, nothing happens, and you get ICT that enters on this move that forms a fair value gap that actually works, right? Then you get another one that works. He's not buying this fair value gap, it's the second fair value gap. I was going to enter, but I didn't like to chop and thought the 4 hour knew 1 hour should retrace. Well, you see how long it took to retrace. You have this little lunch window here, and one would argue that yeah, the lunch window, like here's 11:30, and you could say, well, here it is. Here's the 11:30 open. Here's the, you know, sweep above these equal highs, but that's not really the case. Because you have to look at obviously signatures and price that tell you the market's going lower. Now, if the market doesn't form a signature, it tells you that you're likely just to go back up there and hit those highs again to form a signature, or it's just going to continue. But studying this, it does get a bit tricky because this is not really 11:30. Like PA was just way too choppy here. Yeah. The entry wasn't the best. You could still get your 20 points. Yeah, that's fine. That's what I'm saying. I can't fault you there because you still got your move. But I probably would have took my chips off the table here because most would argue that this is probably about to send price lower. Well, I don't like to trade 11:30 retracement because 11:30 retracement only goes back after the first high created after 10 o'clock. Or the first low in this case. So I would have went for 1020. But yeah. Point is I would not be trying to enter in anything like this. What I'm trying to get you to understand is the key time opens here, part 2. And the open is right there. Open. It goes only below it, just a hair, accumulates here. and then it moves higher. So, and of course the signature formed when we discussed it. But that's my point on this, my one final last thing is, wait for this retracement. Do not buy this retracement. So sometimes what I used to study is ICT, because what he's aiming for is very specific, and if you are ever to discover what's happening, you will get what I'm saying. But what he's this is how he knows where to buy. So you have this time that is going to continuously trade in the direction it's in. So that's all it's doing. Okay? And then right at a key opening time, right before it, we start to fall lower. Okay? We have to make note of that stuff and obviously decide if you're bearish or bullish. But then when a macro opens in most cases, and we'll just come down here and use something like this, because I think it would be more beneficial to show it this way. Let's just see at like 2 o'clock open, or let's just use 250 macro. 250. Okay. You'll see here, even it doesn't matter because typically what happens is it's a little different, but this is obviously a little chop. It's waiting for something specific, sorry. But you have this fair value gap that got utilized that didn't act. Price could easily manipulated lower and stopped them out when the new 4 hour, correct. So obviously you have the same thing here. If you look at this 2 o'clock candle, you have a new 4 hour candle. Well, obviously if the narrative is bullish, you have your 2 o'clock open there. So anything under that, you would want to quote unquote buy. But what you have to study is like macro opens here, and most people would buy here, and then it gets stopped out, because if you put your stop here, you're going to get stopped, and it goes higher. Well, always wait. Sometimes a macro opens and you're up here. See how this macro opens and you already see the move higher? Let's just say this already got utilized and then a macro open. Well, sometimes what happens is you'll see ICT enters on something like here versus this. He enters on something like this versus on, well, why not this fair value gap, or why not that? Because most people like to buy up here, because you could use this too. Here's 10, okay? And so what I'm trying to get you to understand is there's a reason why it retraces, and you have to study that. So if it's to come back, and I'll take this off, why would you not buy here or this fair value gap? Because see, this is where most people get smoked at, right here. Bam. They buy this fair value gap. They buy that fair value gap. Bam. Slammed. Guaranteed. Guaranteed. Because it used to happen to me all the time. So I know that. So. But. I just want you to start studying retracements and where to buy at, because that will yield you more points than just buying at the highs, for example. So anyways, yeah, you can buy in London, but you have to buy after 2 o'clock. And because you can ride this puppy, I just studied this, so you can buy this puppy all day long. And you can hold it into that, because this damage was already done. Got this move. You're just waiting for a signature. Bam. That's it. That's all. I don't see this. I don't see this junk. This is just back and forth nonsense. It's not creating anything significant in price, because you have this previous day where you got this down close move, and then you go higher, 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 higher. Then it waits for. I did not. So what I traded. Here's what I traded on that morning. I shorted in here, took my points here, and then I longed it here, back to here. That's all, because I obviously knew I wasn't going to be trading because I had other things to do today. But I can go in, it's 6 o'clock. So I go in here, and I didn't catch this high. I didn't really care to because I opened up my charts like right after it. So, anyways, bought here. Knew this was manipulation. They run these stops here, and then it's nothing more than a continuation higher. So, that's it. That's all it is. Why did you short at all-time highs, and why didn't you hold on? Just curious, not trying to be. No, you're good. Because I am learning to be content. So these moves can be bought and sold. Like I don't have to stay in a move all day long. I don't want to stay in a move all day long because then I have to watch it. Well, I have other things to do, especially yesterday. But you can short all-time highs. It's not a problem, but you have to know what you're shorting. That's it. Because all-time highs would be here, but I shorted here as a short retracement, and then the move goes higher. So that's it. You just get to move higher. Yes, it's correct. It's referring to specific times, as ICT has mentioned. Correct. Well, time and price. So time first, then price. Without time, price doesn't matter. Because this is a good example. If you have just take this candle, 531, just a random candle, drag it over. It has no significance until time is included, right? 705. Sometimes you get post, 30-minute windows or whatever, but there's 20-minute and 30-minute windows that are significant. I mean, but nonetheless, I mean, it's so, holy crap. I mean, there's a lot that goes into this. This is not just for the kicker. This is 9:30 open here. I didn't short 9:30 open. I short at 6 o'clock. So 6 o'clock open. Here's your 6 o'clock open. Here I see this move higher, open high. We're going down for some manipulation lower to buy under 6 o'clock lows, and then we go bam. Yeah, no, I did not trade. This is not the 9:30 open. Just to clarify, I traded pre-market, and it was not much of a move. It was here and here, but that's more than enough for me. Because I think a lot of people get unrealistic expectations. If you can't gain 20 points on a consistent basis, and here's the thing, you don't even have to be a 500-point trader. I swear to you, you don't. You can size up on freaking 5, 6, 10 contracts on 20 points, and I swear to God, you will take as much money as this market as you want. And if you are able to nail down consistency and accuracy, you can do it that way. So that's what I'm aiming for. I want to be able to be in here for no more than an hour a day. Time and price. It's nothing more. Look, macro opens, and then what? We move higher. Well, why do I know it doesn't need to move lower? Because it already did. It ran these sell stops. That's all it did. Ran the sell stops. I sold here. Sold here. Rebought my sells here. And then price goes higher. Well, there's your order block. Okay. Same thing here. Bam. Move higher. I bought on this inversion, technically, here. Bam. And then I just held it to this high. Nothing crazy, nothing to it. Didn't waste a lot of time. Got my points, got 40, 50 points, and I'm done. No, I don't like trading that. No, it's not based on macro times, because I can trade outside of a macro too. There's inverse relationships to a macro and trading outside of a macro. So trading outside of a macro requires you to understand where you're at in price right now, and because these are ambiguous turning points, right? These turning points are nothing more than signatures. Every turning point, I'm not going to say every turning point, sorry. Every significant turning point is based off an algorithmic signature. That's why you have to study the beginning and ending of moves, because that tells you what's happening. Okay? That is the reality. You have to do that. Study the ends of moves and the beginning of moves. And it will tell you more than you need to know. Now, the meat of the move is the middle. That's where the meat is. You can get your trades, you can make your money from the middle of the move. You do not have to time the bottom or the top. But if you're able to understand that, then you know what direction you're in, and you're able to get the meat of the move, the middle portion, way easier. But anyways, guys, I'm going to wrap this up. Maybe I gave you a little bit to study, but nonetheless, I don't ever get into the specifics. I require you to go study. Go study what I've shown you in the public markets if you are interested in learning from a private manner. Here, I'm reading the chat again, so before I leave, I'll try to answer this question. 1028. Here is what you're talking about. Why this move lower here? I assume that's what you're asking. The SMT with ES. This. Yes, those equal lows. Yes, I wanted these. And then I realized the same thing I told you guys. This is kind of me staying too zoomed into a 1 minute chart. It happens. I have to sometimes bounce back. Because I was looking for, I don't remember where it was, an inversion somewhere. But it did not, I think it was this one. I was looking for an inversion here, and I did not even pay attention to this whatsoever. I was looking for a run lower here, run these stops, and then go higher, but I didn't pay attention, and it didn't need to go lower. This was the damage, so no need to it does not need to come back here, especially if you're bullish. That's what you have to understand when you pull up that conversation that I had up earlier, which I don't have it up anymore, but if you go and pull up, go back to what I showed you guys for the cycling, somewhere in this video, you'll see that what I was referring to was it's a continuous cycle of internal to external. Internal, assume external. Internal, external. Internal, external. That's all it is. So until that tide change, then we just continue on that path. Your best odds are continuously run the highs. But you have to know where it's going. Anyways, guys, I appreciate it. If you could just drop a like, be awesome. I possibly may live stream Wednesday, so we'll see. But yeah, I appreciate you guys for tuning in. You have all weekend to study, so yeah. If you need anything, feel free to reach out.